Warren Buffett has used these 7 investing criteria to become one of the richest and most successful investors of all time. And in today's video, we're going to do a search to find what companies in North America meet all 7 requirements today in 2023 so that we can get a sense of what kinds of companies Warren Buffett might be looking to invest in this year. It's really easy for a company to hit 1 or 2 or even 3 of these criteria, but to hit all 7 is actually a pretty high bar. And you'll see as we apply these criteria and whittle down the companies, there's actually very few stocks that meet all 7 of these criteria. All right, the first criteria is size. And with this, we're trying to weed out small companies, even medium-sized companies, because we only want to invest in stable and secure companies with a long-term future. And so we're only gonna look for companies that have annual revenues of at least $100 million per year or more. The second criteria that Warren Buffett uses is the current ratio, which looks at the amount of assets a company has versus their liabilities. And the current ratio that we're looking for here is a minimum of 2 to 1, which means $2 in assets for every $1 in liability, because that signifies a company that is in a strong financial position and it isn't over leveraged and doesn't have too much debt. And you can see from just these 2 criteria alone, we're already down to only 1,314 potential stocks that fit these 2 criteria, and we still have more to go. The next thing that Warren Buffett looks for is a history of consistently paying dividends and also consistently increasing the amount of dividends that are being paid. And so in our search here, we're going to use the dividend growth rate 5-year average and put it at a minimum of 0% or higher, meaning that there's at least a slight increase in the dividend or it's staying the same. And with that, we're already down to only 294 stocks left. All right, the next 2 criteria that Warren Buffett looks for are related to earnings. And so I'm gonna lump them here together. But basically he looks for earnings stability and also earnings growth. And so for the purposes of this little search here, I'm only gonna look at companies that have positive earnings per share growth on average over the last 5 years. And that will weed out any companies that have volatility in earnings per share and also that are going negative. And after applying that, we're left with 211 potential stocks to invest in. All right, the 6th thing that Warren Buffett looks for is the price to book ratio. And essentially this means how much does the company cost in terms of its market cap and its share price versus the assets that the company has on the books. If you were to sell off every single asset that the company has, how much would that bring in? And what he's looking for is a price to book ratio that's no higher than 1.5 to 1, meaning that the overall market cap of the company shouldn't be more than 1.5 times the book value of the company, because if it gets above and beyond that, then it's signifying potentially that there's a disconnect, that the company might be overvalued and that it's not necessarily fair value. And you have to remember that's what Warren Buffett is really looking for. He's looking for undervalued or fairly valued companies because he is a value investor. And if we apply that maximum price to book value ratio of 1.5, we're whittling down from 200 to 40 potential matches, and we still have 1 to go. The final thing that Warren Buffett looks for, and this is also related to valuation of the company, is price to earnings. Now the PE ratio is kind of similar to price to book value in that it measures valuation, but in this case it's measuring the price or the market cap of the company versus how much it's actually earning. And what he's looking for is a company that has a PE ratio of no greater than 15 to 1, because anything that has a PE ratio above and beyond that is again potentially overvalued, and that's not the type of company that Warren Buffett invests in. And so here on this slider here, you can see that companies are valued anywhere from 1.6 PE ratios to 174 PE ratios, which is absolutely crazy, because the higher the PE ratio, the more overvalued it could be. And if we apply the max value of 15 here, you can see that we're only left with 28 companies after all this. So meeting all 7 of these different criteria that Warren Buffett looks for, there's only 28 companies. Now let's dig into the top 5 and see what kinds of companies they are and whether or not they might actually be good investments for 2023 and beyond. And those top 5 companies are Olympic Steel, Toll Brothers, Pult Group, KB Home, and Lennar Corp. And you'll see as I quickly run you through what these are that there's definitely a theme. Okay, let's start with Olympic Steel Incorporated. Now, first of all, this is the only company in the top 5 after meeting all these different criteria that is in the metals and materials heavy industrial sector. And if we look at the stock chart for this company over the past 5 years, it's performed incredibly. And according to all the different criteria that we just looked at, it's actually still fairly valued because its price to book ratio is very low and its PE ratio is also very low. In fact, if we go back over here, you can see that its PE ratio is 7 and its price to book ratio is 1. So that means essentially that it has almost $1 in assets for every $1 that its stock is valued at, and the PE ratio being below 10 is definitely super reasonable. Now, if we look at the dividend history of this company, it's actually pretty spectacular. The 5-year growth rate average of its dividends is almost 25%, and the earnings per share growth also has been increasing steadily over the last 5 years, which is exactly what you want to see. Now, since October of last year, this company has run up from $23 per share to $56 per share, which is a 100% increase in the company's value. So given that, I would say definitely more research required, but according to the criteria that Warren Buffett uses, this company is still fairly valued. All right, with the next 4 of the top 5 companies here, we're gonna find a theme because each and every single one of them is actually in the home construction business. You have Toll Brothers, you have Pult Group, KB Homes, and finally Lennar Corp. And all of these companies are engaged in the construction of residential homes, and all of them have relatively similar stock charts over the past 5 years. Now, going back to our search here, you can see that all of these companies have a very healthy price to book ratio, and their PE ratios are below even 5 in some cases. Also, their earnings per share have been growing very steadily, as well as their dividends. In some cases, for example, with Lennar Corp, their 5-year average dividend growth rate is almost 70%, which is insane. But this is an interesting case because the pure application of these 7 criteria that Warren Buffett uses doesn't take into account, for example, macroeconomic headwinds, and it's not actually forward-looking. It's looking into the past, and this is the performance on average of these companies over the past 5 years. But that doesn't necessarily mean anything moving forward into the future, especially in the context of rapidly rising inflation and the fact that central banks have been hiking up interest rates significantly, which is almost certainly going to have a major impact on the housing market in North America, and it is definitely driving down demand and it's driving down affordability, which is going to price a lot of people out of the market. And so if we're just looking at these 7 criteria, we could say, okay, sure, they have good PE and price to book ratios, and they don't seem to be overvalued, and their historical dividend growth rate and earnings per share has been excellent. However, if we're looking forward into the future for these companies, especially over the next few years, I'm not so sure if the picture is going to be as rosy, because if there's going to be, for example, a major recession in North America, particularly in the US, then these companies could suffer significantly. And the fact that people are unable currently to refinance their mortgages and that the average new buyer is not looking at making the same kinds of purchases that they were making even just 1 year or 2 years ago is a major headwind for companies like this. And so yes, these types of criteria are definitely useful for screening through the thousands of different stocks that are out there and trying to find companies that might be undervalued. But Warren Buffett didn't become one of the richest people in the world by simply creating a list like this and then just investing in the top 5 companies. You have to dig deeper than that. This could be a useful starting point, but then you also have to sift out companies based on other extraneous factors that you know and are aware of. For example, in this case, the macroeconomic context. Anyways, hopefully you found this video interesting or useful, and if you want to see more content on finance and personal investing, please don't forget to subscribe to the channel. Thanks, and I'll see you later.